Let's move on to an example. Here we have Major League Apparel. They have preferred stock, 6%, $10 par, common stock, $1 par. They're providing us the transactions for the year and additional information that we had net income as of December 31st of $490,000. We're going to do the journal entries, the T accounts, and then we're going to do the shareholders section of the balance sheet. January 2nd, we issued shares of common stock of $110,000 with an issue price of $70. We know that we have par, so let's go ahead and do our calculation here. We are going to have cash equal to the number of shares that we issue times the amount that we issue them at, which is $70. We're going to have $7.7 million of cash. Let's calculate our par. We have $1 par. We're going to multiply that by the number of shares that we issued. We issued 110,000 shares multiplied by $1. That's going to give us $110,000 of par. Now, this is not balanced when we do a journal entry. We need an additional account, and that's going to be additional paid-in capital, which is abbreviated as APIC. Our APIC is going to be the difference between the cash and the par. So we're going to take our $7.7 million in cash, subtract out our par for $7,590,000 of APIC. Let's update our T accounts for these transactions. We're going to have common stock of 110, additional paid-in capital of $7.59 million, and cash of $7.7 million. Under dealer, we see that cash as an asset is increased with the debit, and that our owner's equity accounts are increased with the credit. So yes, this does make sense. Common stock is increased, additional paid-in capital is increased, both with the credit. Let's look at our journal entry. We're going to have cash, 7.7, common stock increasing at 110,000, and the remainder going to additional paid-in capital. Now let's look at February 14th. We're going to issue shares of preferred stock of $60,000. The issue price is $12. We see here that our preferred stock is 6%, which helps us calculate our dividend, and $10 par. What we're going to do here is calculate our cash. We issued $60,000 at $12, so $60,000 times 12 is $720,000. Our par is going to be $60,000 times $10 par. So $60,000 times 10 is going to equal $600,000. For the journal entry, we know that we need to be balanced here. We know that we need additional paid-in capital. $720,000 minus $600,000 is $120,000. Cash is going to be increased by $720,000. We have our preferred stock that is going to be increased with a credit of $600,000 and the difference going to APIC, additional paid-in capital, of $120,000. We have cash increasing, preferred stock also increasing, and additional paid-in capital increasing by $120,000. We are now going to, in May, repurchase shares of our common stock. Let's go ahead and calculate what our treasury stock will be, and then we need to calculate our outstanding stocks as well. We have issued common stock at this point of 110,000 shares. Now we're going to be recording treasury stocks. We, as Major League Apparel, are going to spend our own cash to purchase 11,000 shares of our stock. Treasury stock is a contra equity account. We are purchasing 11,000 shares at $60 per share. The amount of cash that we will spend will be 11,000 shares multiplied by the $60. This is going to be $660,000. This number is what we are going to value our treasury stocks as. Now, let's go ahead and look at what we have outstanding now. We've issued 110,000 back on January 2nd, and now we have treasury stock, which is a contra account, of 11,000. We now have 99,000 shares outstanding. If we paid dividends, we would only pay dividends on the outstanding shares. We do not pay dividends on our treasury shares. Here we have our treasury stock valued at $660,000. Remember, this treasury stock is a contra equity, so it is going to have a debit balance. And here is our cash payment of decreasing our cash of $660,000 as well. Okay, May 8th, treasury stock increasing, it's a contra equity, and cash decreasing. Our next transaction on May 31st is with those same shares of treasury stock. We are going to resell 5,500 of them at $65. We are going to be receiving cash in this instance. So we are going to take our 5,500 shares of stock times our $65 to give us the amount of cash we're going to receive. But what did we buy those treasury stocks at? What did we value them at? We repurchased them at $60. That is the value that we hold them at. So we are going to take 5,500 shares at the amount that we bought them at, which was 60. So 5,500 times 60, we valued those treasury stocks at $330,000. The difference between the cash that we received and the amount that we valued our treasury stock at is going to go to additional paid-in capital. Let's take a look at that journal entry and then those T accounts. Here is our journal entry. Our cash is increasing because we're selling our treasury stocks. Our treasury stocks are decreasing. Remember, it's a contra equity. And the difference between these two is going to be additional paid-in capital. Because we are selling our treasury stock for more than we purchased them, this is going in the direction of a gain. Let's look at our T accounts here. We have our treasury stock decreasing by $330. We have our cash increasing by the amount of cash we received, and we're showing our additional paid-in capital here with regards to this sale. One last thing we need to update is the amount of common stock that we have outstanding. We used to have treasury stock of 11,000. We sold again 5,500 of them. Let's update our treasury that we now have outstanding. We are going to have 11,000 shares of treasury stock. We are selling back 5,500 of them. So now we are going to have only treasury stock of negative 5,500, giving us outstanding shares of 104,500. On December 1st, we did two things. We declared a 6% par value cash dividend on preferred and a cash dividend on our common stocks of 25 cents. I see that this number is given to you here, the amount of preferred stock dividends, but let's go ahead and calculate those together so we know how to do this. We know that our preferred stock is 6% $10 par. That means that we're going to pay $10 times 0.06 as our dividend, or 60 cents per share. We have up here 60,000 shares of preferred stock, so we're taking 60,000 times 60 cents to give us a preferred stock dividend common stock. We are paying 25 cents per share outstanding. We've just calculated our outstanding balance of 104.5. Let's go ahead and do this calculation. 25 cents times our outstanding shares is going to give us 26,125 as our dividends. So on this day, on December 1st, this is the day that we actually owe dividends. We owed no dividends to any of our shareholders before this date. Here we have a dividend, and now we have a dividend payable. What we're seeing here is a dividend, $62,125, and a dividend payable. Let's go ahead and look at the T accounts. We're showing our dividend here. This has a debit balance, and our dividend payable, which is a liability that has a credit balance. One thing I want to point out on dealer here is, look, we have a D and we have an E. Dividends is its own section of dealer. Expense is its own section of dealer. There is no such thing as dividend expense. There are dividends and there are expenses, and they are both increased with a debit, but dividends are a separate line item. Now, what are we going to do on our record date of December 15th? Record dates are very important for companies, especially public ones with lots of common stock outstanding. They need to track down all of the people that own their stocks. On the record date, there is no journal entry made. The next journal entry is made on December 30th when we pay our cash dividends. On this day, we're going to have a cash decrease, and we are going to relieve that payable. We're going to have our dividends payable decreasing of $62,125, and we are making the payment of that cash, decreasing our cash by the same amount. Here we're seeing our dividend payable go to zero, and our reduction of cash by the same amount. Now let's finish out by doing the balance sheet statement of stockholders section. Notice this is on a day and time, not in a period. We have all of our T accounts. There is one update we need to make with this additional information. We have net income for the end of the year of $490,000. This is going to go in our retained earnings. It is going to go on the credit side. Are there any other accounts that we need to close out to retained earnings that we're dealing with? Remember, the temporary accounts are revenue, expense, and dividends. All we have here is a dividend. We need to close this out to retained earnings. This is going to reduce our retained earnings to $427,875. Let's take a look at what's going to happen on our balance sheet. Our preferred stock is going to be $600,000. Our common stock is going to be $110,000. Additional paid in capital, we're going to see that here, for a total paid in capital, which is the sum here of $8.4 million. Now we're going to put our retained earnings in, which we just calculated here. Our treasury stock, that is a contra account. We're going to show this as a negative amount, showing that there, to give us our total stockholders' equity balance right here, which is the 8.4 plus the retained earnings, less the treasury stock, to give us $8.5 million approximately in total stockholders' equity.